Although the statements made by the Australian Securities and Investment Commission at the 23rd of June 2023 hearing sound convincing, this video takes a closer look. Not everyone who had tried to lodge a misconduct report would agree with what ASIC's chairman Joe Longo claims.
Frankly, our communication strategy is something that we're always working on. A better word, I think, other than communication, if I may say so, is engagement. One of the things the Commission and I have been spending a lot more time on, certainly I have in the last 6 months, is actually engaging. And what does that mean? It means meeting with representatives from insurance, superannuation, banking, consumer groups, company directors, auditors, accountants. There's a very wide range of stakeholders and people that are very interested in what ASIC does. I gave a speech earlier this week, indeed, stressing the need for that kind of engagement with the wholesale markets. So, again, that's part of getting it right, if you like. Just going back to your original question, we can more confidently prioritise, we can more confidently allocate resources if we think we're working on the right issues and problems. And we only know we're doing that in part by engaging with those people that we're there to serve.
Mr. Longo makes it sound like ASIC has always engaged with stakeholders, but this is not the case. ASIC consistently showed no interest when it met 3 times with the Trio Capital Fraud Group, and it did not work on the right issues. The Chief Legal Officer at ASIC, Chris Savundra, provided the names of 3 inquiries as an example of how ASIC carried out its work without the need to reveal confidential information. The one of interest here is the Trio Capital inquiry.
I'll pick 3 by way of example, but the first is, and across a spectrum of periods, 2011, the inquiry into the collapse of Trio Capital.
And further on, Mr. Savundra said,
and those committees have been able to closely examine the work that ASIC has done and closely scrutinise that work.
In due respect, Mr. Savundra is wrong. In regards to the Trio fraud, some of the information ASIC failed to share was fundamentally significant to the understanding of the crime. Withholding such information from the Parliamentary Joint Committee undermined the integrity of the committee's investigation and compromised its final report. By being selective with the information it released, ASIC created the narrative it wanted about Trio. The committee could not have scrutinised ASIC's work for the same reason of limited information. Australians deserve an independent investigation into ASIC's handling of the misconduct in the Trio fraud to show the significance of how the covering up and withholding of information misled everybody, interfered with a crime investigation and allowed $194.5 million to vanish without trace. Despite the many unanswered questions, Mr. Longo defends why ASIC refused to release information.
However, ASIC is a law enforcement agency. And as a law enforcement agency, like the AFP, ATO, and other agencies, there are limits on what documents we can share. We need to ensure that our current and future work is not adversely impacted through public disclosure of our investigative files, transcripts, and our legal advice. Information about closed investigations can still prejudice ASIC's related and future investigations. It can disclose ASIC's methods and legal advice and also adversely impact people who have assisted ASIC and, of course, unfairly prejudice people who've been the subject of our investigations.
Over the last decade, ASIC has consistently been reluctant to act against misconduct and has consistently withheld information about its handling of misconduct. The public only get to see the extent of the problem through the media, such as the Four Corners stories, Banking Bad, The Wolf of Woy Woy, and Dirty Deeds, in which ASIC did not help bank victims, refused to pursue the man that duped investors, refused to look at information offered by a whistleblower, and refused to act on a liquidator's report about the biggest tax fraud in Australia's history. Victims of Sterling First and Trio Capital claim they were harmed because of ASIC's reluctance to act against the misconduct in Sterling and Trio. There is no remedy in such situations, as reflected by ASIC Deputy Chair Sarah Court's statement.
ASIC frequently takes civil proceedings against corporate entities. We take criminal proceedings against individuals and on some occasion corporate entities where we have the evidence that will meet the criminal threshold. We don't, as a matter of course, in our civil proceedings seek compensation for individuals impacted. We do from time to time, but we don't, as a matter of course, we're not resourced to do so. Our role as a public enforcement agency is to take enforcement action that sends both specific deterrence to the company involved and general deterrence to the industry.
Australians are mandated into superannuation, yet if money is stolen from the people, ASIC and the police do nothing. The theft by Trio Capital of $194.5 million from superannuation saw no surveillance, no phone taps, and ASIC failed to claw back the proceeds of crime. On the other hand, the money stolen from the tax office, as highlighted in the Dirty Deeds story, saw the Australian Federal Police swing into action. The Australian Federal Police carried out surveillance, tapped telephones, accessed computer systems and email records, confiscated properties and merchandise, and clawed back the $100 million stolen from the tax office. The New South Wales Supreme Court found the Trio foot soldier on Australian soil, Sean Richard, to be dishonest. Mr. Richard claimed he was carrying out the orders of American lawyer Jack Flatter. The New South Wales Supreme Court found Mr. Flatter was the Trio fraud mastermind. ASIC took no action against Flatter, and Mr. Richard served 33 months in prison inside the library with picnics to the beach at the weekends. He and Jack were allowed to keep the $194.5 million. That kind of ASIC deterrence must make the industry happy. Senator Bragg asked Mr. Longo for his view about the compensation scheme of last resort.
I'm aware of the compensation scheme of last resort. ASIC welcomes its implementation. It arose out of recommendations, if my memory serves me, of Professor, or Emeritus Professor now, Ian Ramsey. So I think its policy objectives are to be welcomed, and we welcome the legislation. We think it'll have very significant benefits for consumers in circumstances where their concerns or issues have been upheld by AFCA, and for reasons outside of their control and indeed AFCA's control, those awards can't be paid or met because of insolvency or other circumstances affecting the entity. So I think yes, ASIC welcomes the legislation taking effect, and it's an important new addition to consumer protection in Australia.
The Banking Royal Commission recommended a compensation scheme of last resort to provide a remedy for victims of criminal misconduct. AFCA do not provide a just remedy. The Trio victims tried to lodge a submission with AFCA, but AFCA refused on the basis that Trio Capital was not a member of AFCA. AFCA require companies to pay an annual subscription, and Trio Capital had no subscription because Trio Capital no longer existed. AFCA suggested that Trio be re-registered. The victims made inquiries. One of the big four auditing firms offered to re-register Trio for $45,000. The victims contacted ASIC to inquire about re-registering Trio. ASIC said it might not approve to re-register considering Trio's past history. The victims asked AFCA, if Trio is re-registered, pays its AFCA membership, gets a determination that recommends compensation, who pays the compensation? AFCA said it cannot answer because Trio is not a member of AFCA. The following audio extract from the Minister of Financial Services, Stephen Jones, when talking about the compensation scheme of last resort on ABC Radio.
There is one group, I should point out, one area that we are not going to include within the scheme at the moment, and that is incredibly high-risk products within the managed investment scheme.
Is there a double standard in the handling of misconduct and applying remedy? On the one hand, the union-operated funds that invested in the managed investment scheme, called the Astara Strategic Fund, received compensation. On the other hand, the self-managed super funds that invested in the same managed investment scheme, called the Astara Strategic Fund, were denied compensation. As Mr. Jones points out, too risky to compensate. In the following audio clip, Mr. Longo gives an insight into ASIC's process of investigating misconduct.
I take ASIC's responsibility to be accountable and transparent very seriously. I'm sure you would not expect anything less of me.
And further on, Mr. Longo says,
but we need to raise objections to requests for evidence where it is necessary to do so to protect the rule of law and ASIC's future effectiveness as a law enforcement agency.
ASIC's stranglehold on information can cover up systemic issues such as regulatory failure and regulatory capture, including ASIC's cosy relationships with the banks, where consumer losses were huge, from fees with no service, junk insurance, retirement scams, and funeral insurance scams. The lack of transparency means that consumers have no way of knowing if ASIC thoroughly investigated a crime, followed the money trail, or attempted to claw back the proceeds of crime. From January 2006 to June 2023, the industry was able to feed other people's money to criminals. $45 billion of the savings of hard-working Australians disappeared in failed and frozen financial products. Where did the money go? And where was ASIC?